Hello, everyone. Today we are continuing our work on monetary policy by focusing on the role of the Federal Reserve. We will look at what the Federal Reserve does, how it regulates banks, and how it carries out monetary policy to stabilize the economy. Federal Reserve performs three major functions. First, it promotes stability in the financial system. This means the Fed monitors risk in the banking sector, prevents crises when possible, and intervenes when necessary to stop instability from spreading. Second, the Fed provides essential banking services, not only to commercial banks and credit unions, but also to U.S. government. It acts as the bank for banks and processes payments across the financial system. Third, the most importantly, the Fed conducts monetary policy. This involves managing the money supply and influencing interest rates to meet the macroeconomic goals such as low stable inflation and maximum employment. One of the Fed's key responsibility is regulating banks to ensure they remain stable and solvent. Bank regulations helps prevent excessive risk-taking and protects depositors. Regulations fall into several categories. Reserve requirements specify the fraction of the deposits banks must hold rather than lend out. Capital requirements ensure banks maintain a minimum amount of the net worth relative to their assets so that losses do not wipe out their balance sheet. There are also restrictions on the type of, investments the banks can make. These rules prevent the banks from putting depositors' money into highly speculative or dangerous assets. Together, these regulations create a buffer of safety in the banking system. A bank run occurs when many depositors rush to withdraw their money at the same time because they fear the bank may fail. Even a false rumor that a bank is insolvent can trigger panic. Since banks only keep a fraction of deposits on hand, a run at one bank can quickly spread to others and create a system-wide crisis. To prevent this, Congress implemented two major protections. The first is deposit insurance provided by the FDIC, which guarantees that the depositors will not lose their money even if their bank fails. This removes the incentive for panic withdrawals. The second protection is the lender of the last resort function. In times of crisis, the Federal Reserve can provide emergency loans to banks that need short-term liquidity, preventing an otherwise solvent bank from collapsing simply because too many depositors withdraw funds at once. Okay, now we talk about monetary policy. Monetary policy is the process by which the Federal Reserve manages the money supply and influences interest rates to achieve macroeconomic goals. The two goals of monetary policy align with the Fed's dual mandate, low inflation and maximum employment. When the Fed increases the money supply and lowers interest rate, it is engaging in expansionary monetary policy, also known as loose monetary policy. This approach is used to combat unemployment and stimulate spending during a recession. When the Fed decreases the money supply and raises interest rates, it uses contractionary monetary policy or tight monetary policy to slow down inflation when the economy is overheating. These policy stances are countercyclical, which means they move in the opposite direction of the business cycle. So who mainly conducts the monetary policy? The Federal Open Market Committee, or FOMC, is the policymaking body within the Federal Reserve. It sets the target federal fund rate, which is the interest rate banks, charge each other for overnight loans. This rate acts as the foundation for all other interest rates in the economy. To achieve its target, the Fed uses several toolkits: open market operation, changing reserves and discount rate, and adjusting interest rate on reserve, and implementing quantitative easing. Open market operations refer to the Fed buying or selling treasury bonds in financial markets. When the Fed wants to lower interest rate, it buys bonds from banks. This injects the reserves into the banking system, making it easier for banks to lend and thereby pushing interest rates down. When the Fed wants to raise interest rate, it does the opposite. It sells bonds to bank and removes the reserves from the system. With fewer reserves available, banks, restrict lending and interest rate rise. Open market operations are the fast, you know, primary and most flexible tools for influencing short-term interest rate. So this is the example to explain the open market operation. Mars Hill Bank begins with $460 million in assets, which include reserves, bonds, and loans. It also has $400 million in deposit as liability, and its net worth is $60 million. With the reserve requirement of 10%, the bank must hold $40 million as required reserves based on the $400 million in deposits. This initial condition sets the stage for examining how a Fed bonds purchase affects the bank's balance sheet. When the Federal Reserve buys $20 million in bonds from Marshall Bank, the bank's holdings of bonds decline by $20 million. At the same time, its reserve balance increases by $20 million because the Fed pays for the bonds by adding to the bank reserves. This transaction increases the bank's liquidity, giving it more funds available to lend. Next, the Marshall Bank only needs to hold $40 million in reserves to meet its requirement. After Fed's bond purchase, the bank now holds $60 million in reserves, $20 million more than it needs. Because banks earned profit from lending, Marshall Bank will loan out the excess $20 million. As the bank makes this loan, its loan assets rise by $20 million. This demonstrates how open market operations create money. The Fed's purchase increases reserves, which encourages banks to lend more, and the lending process expands the money supply. Another tool is changing the reserve requirement. The reserve requirement represents the percentage of deposits bank must hold, either as vault cash or as reserves at the central bank. If the Fed raises the reserve requirement, banks, must hold more of their deposits and therefore have less money available to lend. This reduces the supply of credit and slows the economy, making it a contractionary policy. If the Fed lowers the reserve requirement, banks, may lend a greater share of their deposits, expanding credit and stimulating economic activity. However, because this tool can disrupt the bank operations. So the Fed rarely used large changes in the reserve requirements. And the discount rate is the interest rate the Federal Reserve charges the banks, when they borrow reserves directly from the central bank. When the Fed raises the discount rate, borrowing from the Fed becomes more expensive. Banks will then borrow less from the Fed and try to borrow reserves from each other instead. This reduces the bank reserves and tightens credit conditions. When the Fed lowers the discount rate, borrowing from the central bank becomes cheaper, making it easier for banks to obtain reserves. This expands the supply of credit and has an expansionary effect. The Fed also influences monetary conditions by changing the interest rate paid on reserve balances. If the Fed raises the interest rate on reserves, banks, are more inclined to hold on to their excess reserves instead of lending them out. This raises market interest rates and slows credit creation. If the Fed lowers the interest rate on reserves, bank, earn little from holding reserves and, become more motivated to lend them out. This encourages credit expansion. The Fed also uses, quantitative easing or QE, which involves buying long-term government bonds and mortgage-backed securities. QE increases the money supply and lowers, long-term interest rates, making, borrowing cheaper and stimulating aggregate demand. So through open market operation, the Fed changes the level of reserves in the banking system, and this directly affects the supply of loanable funds. The Fed announces the target federal fund rate and then conducts the open market operation to steer the actual federal funds rate toward that target. If the reserve supply is too low to reach the target rate, the Fed injects more reserves. If the supply is too high, the Fed drains reserves. This mechanism links open market operations to interest rates throughout the economy. In this diagram, the original equilibrium interest rate is 8%. When the Fed uses expansionary monetary policy, the supply of loanable funds increases, shifting the supply curve to the right. The new equilibrium occurs at a lower interest rate, in this case 6%. When the Fed uses contractionary monetary policy, it reduces the supply of loanable funds and shifting the supply curve left. The new equilibrium rate rises to 10%. These, these movements illustrate how monetary policy directly influences borrowing costs. Monetary policy affects aggregate demand by changing interest rates and the availability of credit. When the Fed increases the money supply through expansionary policy, interest rates fall. Lower interest rate encourages households to borrow for consumption and firms to borrow for investment. As borrowing rises, both consumption and investment increase, shifting the aggregate demand to the right. This leads to a higher price level and higher real GDP in the short run. In contractionary policy, the Fed reduces the money supply and then interest rate rise and borrowing decreases. Consumption and investment fall and shifting aggregate demand left, leading to lower real demand and lower inflationary pressure. The fourth scenario, the economy begins in a recession at equilibrium E0 with output below potential GDP. Expansionary monetary policy lowers interest rates and stimulates borrowing. As aggregate demand shifts from 80 to 81, the economy moves to a new equilibrium at E1, where output returns to potential GDP. The price level rises slightly, but the main effect is restoring full employment. In the second scenario, the economy begins at a level of output above potential GDP, indicated by equilibrium E0. At this point, the economy is overheating and facing inflationary pressure. Contractionary monetary policy raises interest rate, reducing consumption and investment. As aggregate demand shifts from 80 to 81, the economy moves back to potential GDP at equilibrium E1. This stabilizes price pressure and prevents the further inflation. Thank you for watching.